We're told precious metals are the ultimate safe haven when geopolitical chaos strikes. With a war in the Middle East, Hormuz disrupted, and oil up 52.9% year to date, this should be the perfect environment. But it's destroying them instead. Silver just experienced its worst crash since 1983, down 48.4% from its highs. Gold suffered the worst weekly drop in over 40 years. Together, these supposed safe havens have wiped out $13.5 trillion in under 2 months. Today, we break down why silver is collapsing, separate the speculative leverage from the physical fundamentals, and show you the exact signals that determine what happens next. My name is Nick, and this is Coin Bureau Finance. Let's dive right in with the macro paradox we're living through, because the current global landscape looks like a perfect storm for precious metals. West Texas Intermediate crude oil is sitting at around $90 a barrel, which drives up the cost of manufacturing and transportation across the entire global economy. Inflation expectations are rising again, with the consumer price index running at an annualized rate of roughly 2.6% over the last 6 months. And when you combine sticky inflation with a major global conflict disrupting supply chains, investors are supposed to panic and buy physical assets to protect their purchasing power. But the reality is quite different. Instead of a parabolic flight to safety, silver has crashed from its all-time high of $121.3 on 26th of January to just $62.59 today. On the 30th of January alone, the price of silver collapsed from $115 down to $78 in one single trading session, a 32% wipeout in a matter of hours. Gold has followed a similar trajectory, falling about 25.6% from its peak. And this, of course, begs the question of how the supposed ultimate store of value is getting crushed while the geopolitical risks it is meant to hedge are actually increasing. The answer comes down to the plumbing of the global financial system, and specifically the bond market. Because while everyone is watching the headlines out of the Middle East, institutional capital is watching the United States Treasury yield curve. Currently, the 30-year Treasury yield is sitting at 4.96%, which is just 4 basis points away from the psychologically significant 5% level. Put simply, folks, that yield changes everything. When you can earn a guaranteed risk-free return of nearly 5% on long-duration government debt, the opportunity cost of holding a non-yielding asset like silver becomes incredibly high. Precious metals do not pay one single dividend, they do not produce quarterly earnings, and they actually cost real money to store and insure in physical vaults. So when the risk-free rate rises, institutional asset managers dump their zero-yield metals and lock in that 5% bond yield instead. And the Federal Reserve is actively reinforcing this dynamic. Despite cutting interest rates by 50 basis points last year, the Fed has now paused its easing cycle, holding the federal funds rate steady at 3.64%. More importantly, they are actually signaling only one additional rate cut for the entirety of 2026. Traders are even assigning a 50% probability of a rate hike by October. And this hawkish monetary policy is being driven by an unexpectedly robust US economy, which posted a staggering 8.3% annualized nominal gross domestic product growth rate in the second quarter of 2025, followed by a 4.5% growth rate in the third quarter. When the economy is growing that fast, the recession fears that usually drive safe haven demand completely evaporate. And that takes us to the next major headwind, which is the strength of the US dollar. The dollar index is up 1.75% year to date, which might not sound like a massive move, but it acts as a mechanical weight on the price of commodities. Because silver is priced in dollars globally, a stronger dollar means it takes fewer dollars to buy the exact same ounce of physical silver. And this creates a classic stagflation trap that completely paralyzes the Federal Reserve. Because oil-driven inflation is sticky and impacts the entire supply chain, the central bank cannot cut interest rates to stimulate the economy without risking a massive secondary inflation spike. And this paralysis means there is absolutely zero monetary stimulus coming to the rescue of precious metals markets in the near term. And silver gets hit from both sides of this equation because rising rates reduces investment demand while a potential industrial slowdown threatens manufacturing demand. In fact, we're actually seeing a coordinated commodity sell-off right now, with oil actively plunging 10% today alongside the metals, which strongly suggests a massive wave of forced liquidations rather than a simple shift in geopolitical sentiment. But just to be clear, the macro environment alone does not explain a 48.4% crash in a matter of weeks. But to understand the sheer violence of this sell-off, we have to look at the massive speculative bubble that formed on top of the silver market and how it is currently unwinding. Before the crash, silver went on a historic bull run, surging 345% from its baseline to $121.3 peak. And that kind of price action attracts a massive amount of leveraged momentum trading. At the height of the frenzy, there was an estimated $6.8 billion in speculative silver futures positions sitting on the books. These were traders buying paper contracts with borrowed money, betting that the geopolitical headlines would push the price even higher. But when the CME Group, which runs the commodities exchange, suddenly raised margin requirements from 15% to 18% in mid-February, the trap was sprung. That 3% hike forced highly leveraged traders to either deposit more cash immediately or sell their positions to cover the shortfall. Most of them were forced to sell, and this triggered a brutal cascade of stop losses where selling begets more selling, driving the price down further and triggering even more margin calls. We know this was a speculative flush because the data proves it. The Commitment of Traders report shows that managed money net long positions have plummeted by 77.7% year over year, dropping down to just 12,121 contracts. Gross long and short positions among large speculators have fallen to a 13-year low. The speculative leverage has been completely flushed from the system. The Bank for International Settlements recently released their March 2026 quarterly review, which framed the entire January spike and crash as a classic boom-bust cycle. They noted that the price action was driven entirely by speculative excess rather than a durable repricing of fundamental value. And the exchange-traded funds reflect this exact same retail capitulation, with the iShares Silver Trust shedding over $3.6 billion in assets this year. So, the paper market for silver is being absolutely decimated. But this is where things get truly interesting, because the physical market beneath all that paper is telling a completely different story. But before we get on to that, if you want to keep up to date with the macro news and analysis that the mainstream media isn't covering, then you should sign up for our free weekly newsletter. You can find the link to that down in the description or by scanning this QR code. It's well worth your time and it costs you nothing. Now, if you look purely at the fundamentals of the physical supply and demand, the silver market is actually tighter right now than it has been in decades. We are currently in the 6th consecutive annual supply deficit for silver. For 2026, the projected deficit is roughly 67 million ounces, adding to a cumulative shortfall of 800 to 900 million ounces over the last 5 years. Now, to put that into perspective, that cumulative deficit is roughly equivalent to an entire year of global mine production completely vanishing. And you cannot simply flip a switch to mine more silver when the price spikes. Bringing a new mine online typically takes more than 15 years from discovery to production. In fact, Fresnillo, which is the largest primary silver producer in the world, just cut its 2026 production guidance down to a range of 42 to 46.5 million ounces due to declining ore grades and operational challenges. So the supply side is structurally constrained and the demand side is completely ignoring the price crash. Roughly 60% of all silver consumption comes from industrial applications, and these buyers do not care what the COMEX paper price is doing on any given Tuesday. The solar panel industry alone is projected to consume nearly 200 million ounces this year, because every 1 gigawatt of solar electricity capacity requires roughly 20 tons of silver. The electric vehicle sector is growing its silver demand at a 3.4% annualized rate, eating up over 75 million ounces as the automotive industry shifts toward heavy electronics. And now, of course, we have the explosive growth of AI data centers and server infrastructure. which require massive amounts of silver for electrical interconnects, adding another 75 to 100 million ounces of annual demand. These industrial manufacturers buy silver because they physically need it to build their products, and their factory schedules do not stop just because leveraged futures traders are getting margin called on the exchange. And this relentless industrial demand is rapidly draining the available physical inventory on major exchanges. At the end of February, COMEX registered silver stocks, which is the metal specifically warranted and available for delivery, had fallen 31% down to roughly 86.1 million ounces. By mid-March, that number had dropped even further to 78.95 million ounces, and that represents a staggering 75% decline from the 2020 peak of 290 million ounces. And the physical delivery volumes are breaking records. In March alone, over 10,500 contracts stood for physical delivery, which equates to 52.63 million ounces of actual metal being demanded from the exchange. When you compare the total open interest in the futures market to the actual registered physical inventory, you get a paper-to-physical ratio of roughly 7.3 to 1. And what this means is that for every 100 ounces of silver that someone holds a paper claim on, there are only about 14 deliverable physical ounces sitting in the registered vaults. Now, a fractional reserve system is normal for futures markets because most traders just settle in cash and never actually take physical delivery. But when the registered inventory drops this low while physical delivery demands are hitting record highs, the structural imbalance becomes a massive systemic risk. If that registered inventory approaches the 50 million ounce mark, analysts warn we could see a severe liquidity event where the actual exchange is forced to cash settle contracts because they simply do not have the metal. And speaking of physical shortages, we have to talk about the geopolitical wild card that permanently altered the supply chain on the 1st of January 2026. China implemented strict new licensing requirements for silver exports, effectively restricting 60 to 70% of global silver supply exclusively to their domestic market. The requirements are so stringent, demanding an 80-ton annual production minimum and a $30 million in credit lines, that most mid-sized exporters have been completely cut out of the international market. And this severed traditional arbitrage routes and trapped massive amounts of physical silver inside Asia, creating a localized premium where physical metal in places like Dubai trades significantly higher than the paper contracts in New York. We know this is causing acute physical stress because the 1-month London silver lease rate spiked to an incredible 39% late last year, compared to a historical normal rate of just 0.5%. Even after normalizing somewhat, those lease rates are still sitting near 8%, which proves that institutional players are desperately scrambling to borrow physical metal to meet their delivery requirements. So we have a profound paradox. The paper price is crashing due to margin calls and high Treasury yields, while the physical market is experiencing record deficits, plunging inventories, and export embargoes. And this extreme disconnect is exactly why the major banks and financial institutions cannot agree on what happens next. The analyst forecast range for silver right now is among the widest in any asset class in the world. On the conservative side, JP Morgan has an $81 average target for the year, citing the tight physical supply being weighed down by those high interest rates. They also outlined a $50 bear case if the speculative unwinding process overshoots the fundamentals. Meanwhile, Citigroup upgraded their target to $150, betting that the physical tightening in global trading hubs will eventually force a dramatic repricing upwards. But the most aggressive forecast comes from Bank of America, which projects a theoretical price range of $135 all the way up to $309. Now, this might sound completely detached from reality, but it is based on a very specific historical metric called the gold-to-silver ratio. And this ratio simply measures how many ounces of silver it takes to buy 1 ounce of gold. Currently, the ratio is sitting at roughly 62 to 1. But Bank of America calculates that if the ratio compresses to its 2011 levels at 32 to 1, silver would be priced at $133. And if it compresses to the historic 14-to-1 ratio seen during the Hunt brothers squeeze in 1980, silver would mathematically have to reach $304 based on the current gold prices. So, the extreme divergence in these bank targets really just comes down to a philosophical disagreement. The bears believe that the macro headwinds of a 5% yield and a strong dollar will continue to crush investment demand, keeping the price suppressed regardless of the physical deficit. They also point to the fact that the solar industry is actively trying to reduce the amount of silver used in each individual panel, a process known in the industry as thrifting. By replacing silver with copper pastes or reducing the paste layers entirely, the Silver Institute actually projects a 2% decline in photovoltaic demand for 2026, despite massive global capacity additions. If that thrifting technology advances rapidly, the structural industrial demand thesis could weaken over the long term. The bulls, on the other hand, argue that a structural deficit cannot persist indefinitely without breaking the physical market. They believe that the paper market tail can only wag the physical market dog for so long before industrial buyers panic and bid the price up to secure their supply chains. And that brings us to the critical levels every silver holder needs to watch. Technically, the breakdown is severe. A silver sliced through the major support at $70, which had held strong through the 3 separate tests this year. The next downside target is the February low of around $64, and if that fails, the $55 to $62 zone are next. To determine whether this is a generational buying opportunity or a cycle peak, watch 2 specific signals. First, COMEX registered inventory. If stocks stabilize and refill, the shortage narrative is overblown. But if inventory keeps draining below 60 million ounces despite the crash in price, it confirms the structural deficit is intact and industrial buyers are accumulating at a discount. And second, the Fed's rate path. As long as rates hold and the 30-year yield hovers near 5%, silver faces a massive opportunity cost. But the moment the Fed pivots, the dollar weakens and that headwind becomes a tailwind. History confirms this. In 2022, rate hikes drove silver to $18 despite a physical deficit. But once the macro pressure eased, silver rocketed to $121. The smart money is already reacting. During the worst of the crash, Sprott raised $2 billion to acquire 18 million ounces of physical metal, effectively transferring wealth from weak hands in the futures market to strong hands in the physical market. Even Turkey imported a record 273 tons in a single month. These entities know new mine supply takes over 10 years to bring online. Today's low prices cannot fix a deeply entrenched deficit. And if you hold physical silver, the supply constraints behind your purchase are actually accelerating. And if you are considering buying, the structural case remains strong, but timing risk is severe. Stepping in front of a margin call liquidation cascade is always a dangerous game while yields stay elevated. Eventually, the physical reality will be reconciled, and understanding the mechanics behind this crash is the one way to navigate it without falling victim to the panic. But what do you reckon? Is this the ultimate shakeout before a supply squeeze, or has the market fundamentally broken down? Let us know your thoughts in the comments down below. And if you want more, check out our video on why the global bond market is dictating the next major currency crisis. That's right over here. That's all from me today. Thank you guys very much for watching, and I'll see you again soon. This is Nick, over and out.